Hi gang, welcome back. Today we're going to talk about a new and exciting way to buy pullbacks and sell rallies. This is something Gann never showed us, and it is based on a manual I did back about 10 months ago called Deeper Mysteries of the Market Revealed. Stuff that Gann never showed us. And I updated it. So for those of you who already own this manual, you received an updated version of it. So please, if you see the discount promotion at the end, don't buy it again. Okay, but the thing is, what I did in that manual is that I noticed that there were a lot of situations where we had multiples of 36s happening. Have you ever noticed that the time or the price ends at a 108 or a 216 or a 252 derivative and you never really knew why that was? It's because the price action is looking to express a three-dimensional circle on a two-dimensional price chart. But that's not the main focus of this project. In this manual, in the process of achieving that, I came up with a revelation called cumulative, which is the exact opposite of retracements, and that's what I'm going to show you. So consider this to be like the anti-retracement. Give an example. This is a chart of the US dollar. This is a tight consolidation, and this happens before the trend forms. Now, it's easy to retest a trend line and get a good buy or sell, but what happens if the trend line hasn't formed yet? Okay, then what do you do? Well, in this situation, we have 94 cents down, 0.615 up, which equals 1.555. Instead of dividing 61 into 94, we add them together to get 1.555. And why is that important? Because this leg up is 54 bars on a 30-minute time frame. So it does square out. And here's the standard disclaimer. This basically means everything I'm showing you is for educational purposes only, and viewing or purchasing any of the content here constitutes you agree with the notice and exempts the author, agent, distributors from any liability and or litigation. That's all. You know that. That's a standard disclaimer. Okay, so what I was just showing you is right in here. Okay, if we go back to the first chart, we're right in here. So in the bigger picture, what we ended up having was a $1.22 up and 23 days from here to here. So it all squared out over here. But then what do we do to fight for the best possible price? That's here, right in here. Okay? That's how we fight for the best possible price, the best possible risk-reward ratio. And likewise, that's where we are. And obviously, well, it's not obvious if you don't know. It's obvious to the informed that all of these square outs usually lead to the best part of the move. Now I'll show you a standard retracement. Okay? This is what everybody knows. 40 and 54, the way we do it is we take the smaller leg and divide into the bigger leg, but we also take the bigger leg and divide into the smaller leg. In this case, it's 54 points down, 40 points up, and that equals $1.35, and it replicates with the high, which is 735. And just for kicks and giggles, 40 and 54 is 74% retracement. And it's a 74% retracement. Could we make a stretch and say that 735 is part of a 74 vibration? I won't go that far. I wouldn't ask you to or tell you or suggest in any way that you should be putting money on that. But the retracement stuff, the replication, the fact that the bigger leg is 1.35 times the smaller leg with a price high of 735, that works. Okay, so now we're going to start getting into cumulative stuff. Okay, and down here we have 139 points. Then when we go 77 points up, 63 points down, get your calculator, 77 and 63 is 140. So it replicates with the 139. Now check this one out. From 14 to 78 is 64, right? From 78 to 55 is 23. So 64 and 23 is 87, right? So the cumulative point totals at this pullback over here is 87, and that becomes important simply because it's 88 minutes off the low. And that's right here. Okay, now here's the next one. We have an 89-point leg and a 93-point pullback. That equals a 182. Now, as it turns out, when we do the retracement, it's a 55% retracement, but the bigger leg in relation to the smaller leg is 1.82, which absolutely 100% matches the cumulative total from this point to this point to this point. After you already had this 87 business, after you already had this 140 business. Now, this is the Dow futures on a 1-minute chart, and basically, we're looking at, 2.5 hours worth of data? And look how many cumulative readings we had. And it works well with the, the actual retracement as well. This is what you call non-linear math. It's a chart that could be in my quantum dynamics manual, but it's here. But this is what nonlinear markets are all about. So, in summary, instead of dividing as in retracements, we add the numbers and match it to time. Like for instance, in this case, we've got 52 points up, 77 points down, 67% retracement, and it's 67 bars to here. So it works either way. And look at the low, 668. That's not a coincidence either. So we're not saying retracements don't work. We're saying that in many instances, what you'll find when there are no retracement values apparent to you on the chart, instead of letting it go, why don't you try adding the two numbers together and match it with time and see what happens? You might be surprised. Okay, then it gets creative. Check this out. In this case, we had like a little double top here, so it's 105 to 108. 108 points. That's 668 to 776. 48 points down. The cumulative total is 156. And this hits at 55 minutes after the hour. Okay? But look at the progression of replication. Here you got one leg ending at 47 minutes after the hour. Here you have 48 points down. And here we have 48 degrees, which is 48 4-minute charts. And then that leads to the best part of the move. But you come to expect that out of price and time already, haven't you? Okay. So, doing a little bit of the internals, what we have here, it's 108 points. But I think this bar was what, 105. I'm not sure about what that was. This is basically 108 points, 48 points down, 156, and it's 55 minutes after the hour. Perfect, perfect setup. Now I want you to show you this. This one really doesn't relate to this particular project, but it's more or less a continuation of an example that I showed you in the traps and inducements manual. We were looking at this trap line over here, and it held, it got tested 3 times, and then it finally broke through. When it breaks through, this is what I want to bring to your attention. Here's your trap. When is it safe to go long? Well, if they break the trap, obviously these people are not isolated anymore. And the more the people can nibble up here, the more they realize that the sellers are not showing up. And then when it retests the line at polarity and bounces off, then you see everybody comes in. So this is a way to think about traps in a new way when they don't work. They don't fail all at once. It's kind of like everything is like a process. People say, oh, the resistance isn't holding anymore. Let's see what happens. So it starts drifting, and the sellers don't come in, and that there's a point in time where everyone realizes that this thing's going higher, and that's what happens. But people don't realize that it's going higher just as it breaks through, because it broke through a little bit over here, broke through a little bit over here. But this is a real breakthrough. But you have to allow the process to play out. Now, this works on stocks as well. This is a daily chart of Tesla. Okay? So basically, what we have here, from this 271 high, 89 points down, 82.86 up, 170 equals 171.86, right? Do the math. Replicates the 71 vibration over here, and then it starts to roll over. Cumulative technology, friends. Okay, so you have On this one, this is one of the new darling stocks, MicroStrategy. You got 82.70 up, 81.30 down. That's 164, and it's 65 days, right to the trend line. Now you could say to yourself, hey, what do I need this cumulative stuff for? All I need to do is buy at the trend line. Now, how many times does price action hit a trend line and you don't know if it's a good low or not? You have uncertainty. You don't really know what to do. So it's wonderful to look at it after the fact, but when you see the cumulative point totals lining up with time as it does here, when you see this in the future, first of all, you're going to know what to look for. Second of all, you're going to know what to look for. And when you see it, you're going to get convicted that this is an opportunity. You should be thinking that way. Okay, so now the second part, you got 49.95 up, 38.66 down. The total is 88.61 cumulatively, and it's 88 days off the low. It's the same thing as I just showed you on the intraday chart. Same tendency. Where is it? Yeah, right here. The 87, cumulative, 88 minutes. It's the same thing on a 1-minute chart. As it is on the daily. Right there. Right? 88 cumulatively. So, doesn't matter if you don't trade 1-minute charts. I'm showing you this works universally. So we move on. Now this is a pattern that really ties people up because it happens a lot. It's a tight consolidation around a high. Now this could be a secondary high. This could be the end of a bounce. It could be the actual top. Really doesn't matter. You've got a double high at 153. Now you really can't figure out any retracement values because there are none. So how do you make heads or tails out of this? Well, the drop is from 153 to 145, back to 153, cumulative at 16 points, right? Then it's 28 and 45, which is 17 minutes. So price and time square out, 16 and 17, that works. And that's the start of a down move. Now, in my Deeper Mysteries manual, we take multiples of 36 and determine how much of a circle has elapsed and does that replicate and match and embed itself in the price action. So we take 16, divide by 36 to get 0.444, and it corresponds with this low 145. You have to understand that these things are not coincidences. And it's real, but the fact of the matter is, and nobody else looks at this sort of thing. You go through hundreds of videos on Elliott Wave, on cycle work, on Gann work, SMC, you name it. And no one's showing you stuff like this because they don't even know that it's there. But look at the edge that it gives you. But you have to understand that it is an edge. Cumulative totals give us the exact price pivot. Check this out. 180 to 90, that's 90 points, right? 90 to 172 is 82. What's 90 and 82? Gee, that's 172. Look at the high here. The price is 172. You just can't make this stuff up. And this stuff is the stuff that I just showed you in the prior video, in the prior slide. It's a little low double high, move down to the moving average. It's a little trading leg, 115, 153 to 117. There's a 36-point move in, what, a couple hours? Couple, 3 hours, whatever it is. It's not bad. Okay. So now that I showed you all that, and I gave you a hint about three-dimensional circles and transposing it on a two-dimensional price chart, let me just give you an example of what I mean by that. Take GM, for instance. This move is 157 days. Now, if you divide that by a 360-degree circle, you end up with 0.436. Now, that doesn't mean all that much until we see that the price action, the high is 43.63. Is that a coincidence? Let's take the same GM, right? And that's GM, daily, GM, 1 minute chart. 16.16 down, 16 cents. You divide that by 3.6 because everything is relative, and what ends up happening? It's 0.044%. Well, that doesn't mean anything until we realize that this move is 45 minutes down. Is that a coincidence? I've done a whole manual, and we get really deep in this. Finally, 24 minutes to here, up and back, divided by 36 is 0.6667. And so then when you take the cumulative totals, which is 22 and 43, 43 cents up, 22 cents down, that's 65 cents. So you've got 65 cents cumulatively, which is lining up with the fact that the time is 0.6667 of a circle. That's not a coincidence, gang. Now I'm showing you this because this is really how markets work. I've seen so many videos and so many teachings over the years on how to do circles and angles on charts, but the problem is most of us don't have that software, so we can't actually pull it off. And then the problem is once you do get that software, then when you change time frames, it messes everything up, and then you have to redo it if you change the time frames. So I said, the heck with all that. I'm going to try to figure out how we could just transpose this straight on the chart. And this is how you do it. So that's basically it. Now we have our little discounts. This is a manual that I've done earlier in the year, and I upgraded it for the people who had already purchased it, so please don't purchase it again. But this Deeper Mysteries of the Market Revealed includes new strategies on buying dips and selling rallies Gann never showed us. It's $37 through PayPal. Send funds to lucaswaveman@gmail.com or request an invoice and mention this video. We're still promoting the ultimate guide to bull and bear traps, and there's another video here about this. That's also $37 through PayPal or request an invoice. You don't even need to mention the video, although that would be nice if you did, because this is the price. And don't forget to like and subscribe if you like what you've seen here. So our YouTube special training is $587, includes a call every other week on Skype for 12 months, unlimited email support, all the manuals, which is a complete NFL-sized playbook. It has everything you could think of. Now, the regular price on this is $987. So if you want this $400 savings, you must mention this video to get the discount. And everything that I'm showing you is part of the training program. And that'll do it for now. Thanks for coming. Until we see you on the next video, take care.